All right, welcome to The Explainer. Today we're cracking open two of the most popular investment tools out there, mutual funds and ETFs. Now on the surface, they seem almost identical, right? But here's the thing. There's a hidden difference in how they're built, and it can have a massive impact on your wallet.
So let's kick things off with a bit of a puzzle. What if I told you that one of these funds has a structural flaw, a flaw so big that it can force you to pay taxes on your neighbor's profits? I'm serious. You could get hit with a tax bill even if you haven't sold a single share, just because other folks decided to cash out. It's not a what if, it's a reality for millions of people, and it all comes down to this one critical detail we're about to expose.
You know, for years and years, these two have been the absolute go-to for easy diversification. The mutual fund, that's the old guard, right? The original way to buy a whole basket of stocks with just one click. And then you have the ETF, the newer, sleeker challenger that's really been taking over the scene. They both promise to solve the same problem for you, but believe me, how they get there, totally different worlds.
Okay, so the first big difference? It's not some deep, dark secret. It's right there in plain sight. It's all about how and when you can actually buy and sell them. Think of it like this. Are you waiting in a line that moves once a day, or are you trading in real time?
So with a mutual fund, let's say you place an order to buy or sell. Doesn't matter if it's 10 in the morning or 2 in the afternoon. You don't actually get the price from that exact moment. Nope. You're basically putting in a request slip, and that request, it's going to be filled later, only after the market closes for the day. And that one single price for the entire day is called the net asset value, or NAV for short. Every single person who bought or sold that day, they get that exact same price. Now, on one hand, that kind of insulates you from any crazy swings during the day, but on the other hand, it gives you absolutely zero flexibility. Breaking news hits? Too bad, you've got to wait.
But then you have ETFs, and they're a completely different beast. ETFs, or exchange-traded funds, they trade on stock exchanges just like a share of Apple or Amazon. What does that mean for you? It means their prices are moving all day long, second by second. You can buy, you can sell, instantly, at a price you can see, reacting to whatever the market is doing right then and there.
So let's just boil this all down. A mutual fund transaction, that's between you and the fund company, and it only settles once a day at one price. An ETF trade, that's you trading with another investor out on the open market, happening in real time at whatever the current price is. It's a fundamentally different setup. Okay, but that whole trading thing, that's really just the tip of the iceberg. The next piece of this puzzle is digging into the true cost of owning these things. Because, and this is important, the answer is not always written on the price tag.
All right, let's talk fees. You look at an expense ratio and you see a difference of, say, less than 0.5%. It seems like nothing, right? Pocket change. But here's the crazy part. Over your investing lifetime, that tiny little difference can grow into an absolute monster. We're talking about over $75,000. That's money that could have been in your pocket, but instead it went to the fund company, all because of a seemingly tiny fee.
But, and this is a huge but, the expense ratio is just the sticker price. It's what they advertise. If you really want to know what you're paying, you have to look at the total cost of ownership. This includes the obvious fees, sure, but it also includes the hidden cost of trading, and the big one, the money you lose to taxes. We call that tax drag. Now check this out, because this is where it gets really interesting. This shows how an ETF with a higher sticker price, a higher expense ratio, can actually be the cheaper choice. So ETF Alpha, it has a lower annual fee, which looks great, but it's harder to trade. That wider bid-ask spread you see, that's basically a hidden transaction fee you pay every time you buy or sell. ETF Beta, on the other hand, costs a tiny bit more each year, but its trading costs are so much lower that it actually ends up being the better deal overall. Wild, right? And speaking of that tax drag we just mentioned, this brings us right back to that hidden difference from our opening puzzle. This is the single biggest, most important structural advantage of the ETF, and it's the whole reason you might find yourself paying taxes on somebody else's profits.
So you have to be asking, how is this even possible? How can an ETF and a mutual fund that hold the exact same stocks have such wildly different tax bills for you, the investor? Well, the answer isn't about what they hold. It's all about how they handle things when investors want their money back.
Okay, so here's the flaw in the mutual fund system. Let's say an investor decides to sell their shares and get their money back. To do that, the fund manager often has to sell some of the fund's stocks to raise that cash. Now, if those stocks have gone up in value, which you hope they have, selling them triggers a taxable capital gain. And here's the kicker. By law, the fund has to distribute that gain to every single shareholder left in the fund at the end of the year. Even you. Even if you didn't sell a thing, you get their tax bill. It's crazy.
All right, now let's look at the ETF's absolutely brilliant solution to this problem. When you want to sell your ETF shares, you just sell them to another investor on the stock market. Simple. That doesn't create any tax event inside the fund itself. But what about huge redemptions, like from big institutions? Well, they use a special process where they swap a giant block of ETF shares directly for the actual stocks themselves. This is called an in-kind exchange. And since no stocks were actually sold for cash, guess what? No capital gain is created inside the fund. Problem solved.
And the real-world impact of this difference? It's not small. It is absolutely staggering. Just look at the data. In a recent year, more than half of all equity mutual funds had to pass along taxable capital gains to their investors. And for ETFs, it was just a tiny fraction, a mere 7%. That right there, that is the tax shield in action.
Okay, so let's fast forward and bring this whole battle into the modern era. Because technology and innovation, well, they've completely changed the game in some pretty surprising ways. They've erased some of those old advantages and created a whole new reality for us as investors.
You know, for the longest time, mutual funds had this one killer feature. It was super easy to set up automatic investments. You could say, I want to invest $100 every single month. And because you were buying directly from the fund, they could just slice off a little fractional piece of a share for you. Easy peasy.
Well, guess what? That advantage is now completely ancient history. It's gone. Today, pretty much every major brokerage out there lets you buy fractional shares of ETFs. You can invest as little as a single dollar into almost any ETF you want. That gives them the exact same accessibility that mutual funds used to have all to themselves.
So is there anywhere left where mutual funds still rule the roost? Yep, the 401k. Think about it. The entire retirement plan system, all the record-keeping, the administration, the whole shebang, it was all built decades ago. And it was built around the simple, once-a-day pricing of a mutual fund. Trying to overhaul that massive legacy system to handle the fast intraday trading of ETFs, it's a huge, expensive headache, and honestly, most plan providers just don't have much incentive to do it.
All right, so after going through all that, the trading, the costs, the taxes, which one is actually right for you? We've unpacked all the differences, so now let's put it all together. Let's build a simple framework so you can make the right choice for your money.
And honestly, this right here might be the most important takeaway of this whole thing. The right choice? It almost entirely depends on the type of account you're using. If you're investing in a regular taxable brokerage account, that built-in tax shield of the ETF is a massive, game-changing advantage, no question. But if you're inside a tax-sheltered retirement account like a 401k or an IRA, well, that tax benefit completely disappears. In there, the decision just comes down to the basics. Which one has the lowest fees and is actually available for you to buy?
At the end of the day, it's really a choice between a legacy system, one that's been proven for decades but has some, outdated engineering, and a modern system that was designed from the ground up for pure efficiency and flexibility. Neither one is universally bad, but one is often a much better fit, depending on the situation.
So now you know. By looking past what's on the surface and really understanding the deep structural mechanics, how they trade, what they really cost, and especially how they handle taxes, you're not just picking a fund anymore. You're choosing the right engine for your portfolio. And you're armed with the knowledge to make a much smarter, more efficient decision for your own financial journey.